Hi, this is Mark Chandik with another episode of Prosperity Perspective. In this episode, we'll be exploring Chapter 6 of my book, Embracing Life Insurance and Annuities. Let's start with the obvious. People have a natural resistance to these two financial instruments. The natural resistance comes from many different places. For example, it might be a horror story from a friend or family member who purchased one of these financial products and had a very bad experience. Or it may be reading countless negative articles on the internet about these products. Finally, it might be a lack of understanding of what these products are supposed to do and how they operate. In other words, it's an educational gap. In this episode, we will take a high-level approach to these two financial products and establish where and when they should be utilized in most people's financial planning. Oftentimes, when I sit down with clients and we talk about the subject of risk management, in this context, I mean dying too soon and needing life insurance to make up the difference, they often ask me if I like term insurance or whole life insurance better. This question really stems from the minimal amount of information that my client has on the subject. In my opinion, it's like going into a hardware store and asking the clerk which is better, a hammer or a screwdriver. Well, of course, the answer depends on what you're trying to accomplish. You don't use a drill to plane wood. Likewise, life insurance products exist in many different forms, and they're designed to meet a wide variety of financial needs. Let's go back to the base of financial planning pyramid. Remember, the base is critically important to your long-term success because it addresses the big risks in life that can completely take you off course. As I said before, one of those is dying too soon. So let's say that you're motivated to purchase life insurance because you have risk exposure. You want to protect the income stream to your family in case you die prematurely, or your assets are illiquid and encompass primarily a privately owned business or real estate, and you want to provide liquidity. Or finally, you have a sizable net worth that is exposed to federal estate tax, and you'd like to purchase life insurance to pay for those taxes in the future. The primary focus, once you have the need for life insurance, is to be very mindful of the amount. Don't focus on the type of insurance, but rather how much is really needed. I've never had a widow ask me after their spouse dies, "Gee, Mark, what type of life insurance did my husband or wife own?" Instead, it's how much life insurance is coming in and is it enough to support my family and my children. If you've done a comprehensive financial plan, you'll know the amount of life insurance you need now and in the future, which is very helpful. If you haven't done that, then there are free life insurance calculators found online that can help you determine how much is needed. A rule of thumb is for a working person to own 10 to 20 times their annual income. For example, if your income is $100,000, then you should consider $1 to $2 million of insurance. In the example of replacing your income, your beneficiary will likely invest those insurance proceeds very conservatively and live off the income. If they can earn 5% on that capital, then $2 million of life insurance produces $100,000 per year of income. This is a back-of-the-napkin calculation, so it doesn't consider paying off a mortgage or funding college for children. Most people, when they go through this process, are surprised how big the number is. Think of it this way. If you were to die in an airplane crash, how much would you want your spouse to sue the airline for because you're gone, and so is all of your future income? Well, the answer is, it's the discounted value of all your future paychecks. We call that your human life value. For most people, that's a very big number. Why should you provide less value to your family than they would have garnered if you died in an airplane crash? Once you've landed on an amount, then the next step is to select the type of policy. The life insurance industry innovates better than most other industries. There are at least 5 major types of insurance. They include term insurance, indexed universal life, variable life insurance, and whole life insurance. The purpose of this video is not to go into detail on each type of insurance, other than to say that term insurance is fundamentally different than the other 4 types of insurance. The key differences include the premium structure, a savings or investment component, and how many years the insurance will last. In general, term insurance policies provide a very low cost structure, So they're well suited for young families that have a high insurance need but don't have a lot of cash flow to pay for it. They also may be ideal for businesses that want to provide insurance to fund a buy-sell agreement or to secure banking obligations. Term insurance could be purchased for 10, 15, 20, or even 30-year durations, depending on your age. The other 4 types of insurance contain a savings and investment component that provides 2 basic benefits. First, it allows the policy to last for a lifetime if funded properly. Second, it can provide for a tax-free income stream down the road for supplemental retirement purposes. The devil is in the details here, so you need to do your homework and work with a knowledgeable and qualified insurance professional. The final thought about life insurance is a question that I'm asked all the time. Do you think I'll need life insurance after I retire? It's a great question and one that can only be answered if you develop a financial plan that projects your needs into the future along with the growth of your assets. Ideally, you'll have grown your invested assets over your working lifetime to such a level that life insurance is no longer needed in the traditional sense. That being said, many people enjoy the peace of mind of owning some level of life insurance during retirement because it can provide for what I call the oops factor. What I mean here is that things happen in life that are completely unexpected. For example, 1 or more divorces increases long-term financial obligations. Another is a sudden downturn in the market that crushes your investment portfolio right before you retire. The Great Recession of 2008 and 2009 is a perfect example of this. Lastly, clients need to consider how they're going to manage the risk of a potential long-term care event. Some life insurance policies today contain a long-term care rider, and that can be very valuable. If you're interested, please look at the previous Prosperity Perspective video devoted specifically to long-term care. Now let's switch gears and talk about another financial instrument that is widely misunderstood, and that is the subject of annuities. Annuities, like life insurance, are highly misunderstood, and conflicting information is in the marketplace based in large part by the point of view of the writer. For example, I often see financial advisors that are not properly licensed to sell annuities be very negative on them. So I question whether that is really an unbiased opinion. Again, like life insurance, the devil's in the details here, so do your homework. The 2 biggest misconceptions I hear about annuities are that annuities are only distribution vehicles. In other words, they only pay income out. And in order to get that income, you have to give up the right to your principal with no liquidity. Neither of these misconceptions are true. The best place to start to understand annuities is that there are 2 basic types. The first type is designed and focuses on the accumulation of capital in order that an income stream can be started sometime in the future. This type of annuity is called the deferred annuity. The second type of annuity is called an immediate annuity, and this is when the annuity begins to pay an income stream immediately after the capital is invested. There are 3 great examples of payment structures that behave like an immediate annuity used in our everyday lives. First is Social Security. Your paycheck is debited throughout your entire work life, and then you receive a lifetime income stream beginning at retirement age. The second example is corporate pension plans. What I mean here are large companies that still provide lifetime incomes to employees. The third example is public employees and teachers. Firemen, police, and teachers all receive guaranteed income streams once they retire. These payment systems act similar to how an immediate annuity is designed to perform. In all cases, the payments are limited by the full faith and credit of the issuing institution. Like life insurance, annuities have had an amazing amount of innovation as well. In my opinion, the greatest innovation has been in the area of providing liquidity to the annuity owner, as well as providing a guaranteed lifetime income stream. Remember, annuities are issued only by life insurance companies because they are in the business of managing longevity risk. When income streams begin, it's possible for the recipient to receive back much more income than they had initially invested. Life insurance companies have millions of annuity owners, and some of them die sooner than expected, and some die after they're expected. So it is their job to manage the risk. As previously identified, All guarantees offered by the insurance company are limited to their claims paying ability. One of my previous prosperity perspectives discusses the primary risk that all investors face, and that is longevity risk. In other words, we don't want to run out of money before we die. By utilizing an annuity vehicle, that guarantees lifetime income. You effectively transfer the longevity risk to the insurance company. In other words, it's possible to completely exhaust your annuity account balance, yet you will still receive an income for as long as you live. Annuities have special tax treatment. Specifically, the investment grow on the invested dollars subject to ordinary income tax rates, and there is deferral of those taxes until you access the money. This is fundamentally different from a traditional investment plan that is subject to long-term capital gains rates. In addition, the internal costs for annuities tend to be higher than a traditional investment program. While those costs and tax treatment may seem to be overwhelming reasons not to purchase an annuity, an educated investor should do the math and consider the benefits of guaranteed lifetime income. In some planning scenarios, it might make sense to have guaranteed income from annuities and Social Security combined that cover all of a retired person's fixed living expenses. This approach can provide a very high level of comfort and peace of mind. So in conclusion, what have we learned? We've learned that life insurance and annuities are just more tools at our disposal that are not inherently good or bad. Instead, these financial instruments can be integral parts of a well thought out financial plan. I hope you've enjoyed this episode of the Prosperity Perspective. Please hit the like and subscribe buttons down below if you want to see more videos like this. If you're interested in a free copy of my book, please click the link in the description as well. If you have any questions, don't hesitate to reach out by email, and that email address is in the description below. This is Mark Chandik, and I'll see you on the next edition of the Prosperity Perspective.